Everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today, we're going to go through Twitter, talk about wealth building, commodities, and financial topics. Whatever people are sharing is basically what we'll talk about. A lot of it is things that are happening real time in the markets that people post about, and I interject my financial opinions all through the mix. We are running a 50% discount called August. It's good till the 15th of this month. If you'd like to try out finding-value.com at a 50% discount for the first month. All right, so let's dive in here and see what's going on. Again, if you want to follow me at finding_finance and the website. This is J-Rod Money, I should say. Here's how I plan on becoming a millionaire. Max out Roth every year, get a 6% match in my 401k, $100 a month in my HSA, $100 in each of my son's 529s. Everything else is in the brokerage. Retirement accounts plus brokerage should be around 1.5 million by the time I'm 48 years old. I think there's ways to maximize or compound your returns. The commodity bull market will definitely expedite that for a lot of people. His plan isn't really on becoming a millionaire. This is his plan on where he's going to put his money. A plan needs to be something that is going to get you from A to B. This doesn't necessarily get you A to B. That's more of like a tax strategy than it is a plan on becoming a millionaire. So the one thing that a lot of people get wrong when they try to become a millionaire is they take on too much risk. I see that with a lot of retail investors. They pile into these junior speculative companies, and it doesn't pan out the way that they thought it was going to. I do think that there's time to put on a lot of risk, and there are sectors that have ridiculously good looking patterns where you can pile on some risk, I think, and it might work out for you. But to become a millionaire, I don't think it's all that bad or all that difficult if you get a lot of help along the way. If you can compound and you catch a couple of really good rides in this commodity bull market, it's definitely going to get you in the right step in that direction if you aren't already there. A Roth, you can max out your Roth. If you make less than, I think it's well, I know everything in the world of being married, so I don't know what the individual numbers are, but I think it's like $250,000 or less. You can directly contribute to a Roth IRA. If you make more than 250,000, you can put it in a individual IRA and then do a backdoor Roth, which basically you reclassify it back into a Roth. A Roth is it's an account that you put taxed money into, and it grows and compounds tax free. It is probably one of the best areas to put money out there is a Roth IRA. I have maxed my Roth IRA every chance I've gotten throughout the years, and I've actually done incredibly well in my Roth IRA. It is pretty large. That is where I put a big chunk of my SM Energy investment is in my Roth IRA. And I've got a couple other ones in there as well in the oil and gas sectors that you guys had seen in the middle to end of 2020. He puts in enough money to get a match at work, I'm guessing, in his 401k. That is free money, guys. You should always try to get the match that your company is matching. Some companies pay more than 6%, some pay less. It all depends on what the match is. That is money that is going into your account, probably pre-tax money, and they're matching it. So you're right off the bat, you're getting 100% return on that money that you're putting in your 401k from your company matching you. that is a no-brainer. You're getting 100% return. And if you have employee stock purchase plans, look how the plan is set up. I had a plan where they took the average of the first 10 trading days of the year. They took an average of the last 10 trading days of the year. They compared the two. They took the lowest of those two, and we got it for 85% of the lower valuation. That's a pretty good price if you have an employee stock purchase plan at your work. You can also do a health savings account. Now, a health savings account is an account where you can put pre-tax money into the account and then let it compound tax-free. It is the most powerful account of any account there is because you can take pre-tax money, put it in the account, let it compound tax-free, and take it out tax-free. I'm actually, if I have healthcare expenses, I don't even take money out of my HSA. I leave it in there to compound as much as I can. It is the most powerful account because it is a triple tax benefit account. And everyone should know that a health savings account is the most tax friendly of them all. And I'm not a tax specialist, but I do know a little bit, and that is my opinions around it. These are college accounts, the 529s, and I don't know as much about those. You can also invest in physical precious metals, which are outside of the system, and there are tax benefits to that as well, depending on what you buy, like American Eagles and stuff like that. And if you understand the 1099s and what the requirements are on the dealer side, you might benefit from that as well. Just an FYI. So here's meanwhile, the implied demand for oil just surged to all-time highs. It was the largest weekly increase in 26 years. It is worth noting that U.S. oil production remains 7% below pre-pandemic levels, with total operating rigs starting to contract for the first time in 3 years. Inflation continues to be deeply ingrained within the system as the underlying factors driving it remain in process of being developed. And remember, guys, credit expansion generally increases the demand for oil, and oil is the translator of that credit into inflation in the consumer price index. And that's why he is stating inflation continues to be deeply ingrained within the system. That's the transfer mechanism. It's oil. Oil is that transfer mechanism for inflation. Here's Lance. He says the new U.S. listings tracked by Realtor.com fell 5.6% month over month in July. New listings are down 21% on a year-over-year basis. New listings in July, 374,000, are 27.1% below July 2019 levels. So if you look at the previous years, which are all stacked up against each other, outside of 2020, you can see that 2022, late 2022, we really declined on our new listings coming to market. Look at 23. 2023 is off the chart low here. Well, maybe not off the chart, but it's very low. So again, not many people are listing their homes, and a lot of people say, well, who would give up that 2-point-something, 3% mortgage? I don't know. I'm not. I'm not giving up that interest rate. That's for sure. If anything, I would buy another house and just keep this house and leave the mortgage on it. It's such a good payment, in my opinion. But either way, here's CCJ versus the Dow Jones. I know we talked about this before. He's got this zoomed in a little bit better so we can see it. Here's the time lag that he's got on here. He's got 331 bars, 2,317 days from at least the beginning point here all the way to the end point of this kind of U-shaped pattern that he's got going on here. Then we've got the full fly zone launch, where we launch very much outperformance of Camco versus Dow Jones. And then you can see the Batman pattern, the top, the pullback, and then the top. And then you get the little Batman, and then we go all the way back down. This is definitely a bottoming pattern. It's the rounding one that we've got. We've got similar fractals on the right-hand side here. This guy here is this guy right there. So very similar fractals. We're about to launch into the fly zone. Is this where the big move comes? Yes. Yes, it is. Um, we're also 2,954 days in length of this basing pattern versus 2317. Now we can go and we can buy Camco directly. This is where the major money is positioning. They're positioning in the big boys, which is Camco, Gazette, and Prom, depending on if they want to be linked to Russia or whatever. But this generally moves first. What lags behind are generally the juniors and smaller companies. That is where the opportunities are right now. Those opportunities are there. They're not cash flow machines, so they do carry a fair bit of risk. So they're very risky in terms of no cash flow, you can get diluted. They're not risky in terms of they're going to go bankrupt. It's just you could get diluted to death if they try to raise money to build whatever they're trying to build. But this is more or less a play on money flows. Money flowing into these companies when people see that the SHIT hits the fan and uranium prices go ballistic. I think people are positioning in Camco right here, as we can see, for that big move to the upside. So what I do is I say, okay, this is position. You can play it directly with Camco. There's no problem with that. It's probably one of the premier companies in the sector if you want to do so. Probably a pretty good risk reward. I've got nothing against it. If you want to roll the dice, shake the dice in your hand, throw it, and see if a lucky seven comes up. Then I would look at some of the junior companies. They do a lot of them have very good chart patterns, and they are, I'll say, aligned very well with breakouts of falling wedges to the upside. That generally means that we're going to move to the upside, and we're just waiting for the right launch sequence, whenever that is. That's where I would look. That's where I would look, and I would be positioning basically now. Here's JC. Treasuries are imploding. The algos are selling gold and silver on higher real rates, but the smart money knows this is the scenario that will cause precious metals to go parabolic. A small reallocation from the 25 trillion treasury market will launch the next bull market. He's completely right. So what he's saying is that there's going to be a money rotation from bonds, and that's why we're seeing those interest rates go up, and we're also getting higher real rates with those interest rates increasing. But money is going to have to position somewhere. Gold and silver is one of those areas that it's going to position in, I think. Commodities is another. You're going to get some FOMO bros over in uranium, guaranteed. When that thing starts to crack and roll up, you're going to get a lot of people running at it. The retail sector prefers these small speculative companies. And I think the highest probability of success of any sector in the juniors is probably going to be uranium. That's my guess. So I'm speculating on that. Might as well. I've got some money allocated towards it. It's not it's not the biggest portion of my portfolio, but I got to make this count. You only get one or two of these in a lifetime. I was too young for the previous one. I wasn't really paying attention to it. This time I am paying attention, and I'm going to fully well exploit whatever I can in this bull market this time around in the uranium and also in gold and silver. Jim Bianco, he says the 30-year is up 30 basis points in the last 48 hours. For those not deep into the bond market, this is a huge move. I agree. And that's why we're seeing some waves kind of ripple through the market in some of our sectors. We had a massive selling pressure day a couple days ago. And that's due to this massive move in interest rates. Are there going to be more ripples coming? I'm sure there is. And that's why you just got to be patient, take a deep breath, look at your companies. Are they cash flow rich? Yeah, the majority are. You're probably going to sit pretty well. This increase of interest rates is going to cause money to rotate differently for a while. And it's going to come and hopefully eventually find itself in precious metals and commodities. Here's the stock market. It's broken down badly versus energy. I am an incredibly big energy bull. I love energy. I love this setup. Why do I like this setup so much? Well, If you look at 2020, we went off the page and how cheap we were in relationship to everything for energy. Energy was the cheapest, one of the cheapest sectors. Uranium was really cheap too in 2020. Generally speaking, when you go that cheap to the downside, it overreacts to the other side and will probably be the most expensive it will ever be at some point because we've underinvested so much. Plus, they've messed with this market, guys. They released strategic petroleum reserves out into the market, and that basically delayed investment coming into the energy sector. It's only going to amplify the move, in my opinion. So what he's got here is the S&P versus XLE, which is an ETF. When this goes down, energy is outperforming the S&P 500. Right now, we're in a rising wedge that we are basically breaking out of here. So this is the rejection line. It's rejected. It's falling back down, where we should see energy start to outperform the S&P 500. We can also see that commodities are starting to outperform the S&P 500, and we're getting this alignment going on, which is a good alignment for energy and all the commodity stocks and sectors. Here's breaking. 30-year mortgage rates hit a new 23-year high of 7.2%. So remember those interest rates that were breaking to the upside that we were talking about? That does have an impact on mortgage rates. It says a monthly payment on a $500,000 loan at 7.2% with $100K down is 20% excluding taxes, insurance, and utilities is $2,900. So we are increasing in our mortgage rates, and the affordability is being impacted negatively. Will that have an impact on home builders and a lot of the existing markets in the real estate market? I think it will. I think we're getting to levels of the affordability that it's going to have an impact. Is it going to cause a crash? No, I don't think it'll cause a crash. I think that the market's just going to be in super slow motion. And that's what we're seeing. Peter Schiff says treasuries are collapsing as oil prices surge. The critical markets to watch are the dollar and gold. Once the dollar falls with treasuries and gold rises with oil, the party is over. Say goodbye to a soft landing and brace for impact. Recession plus higher inflation equals a crash. Maybe that is the case. Generally, treasuries, we should say rates, he's saying the treasury price and the dollar will fall. When the dollar falls, that's going to put a tailwind behind our commodities. What that means is that we're getting into the later stages of this commodity bull market. We're like halfway or so. When that dollar falls or that dollar drops, that's when things are going to, I think, really take off. That's when it's going to get fun, and it's going to be life-changing, I think, for a lot of people. The S&P 500 was very strong during the time that it's supposed to be strong. Not sure why everyone was so surprised about it. And now S&P are entering a seasonally weak period of the cycle. You can ignore that if you want to. I won't. So here's pre-election cycle, seasonally weak periods coming up a little bit. And we are entering that seasonally weak period here. Boom. So coming on down. Patrick writes, do not fight this. Your next investment ideas should pay very close attention to this chart. It is showing you where the next macro capital flows are heading. So this is 10-year yields are resuming breakout versus the S&P 500. This is pretty big here, guys. This is 2020. You can see a big move in yields outperforming all the way till October of 2022. We had a consolidation sideways, and now we are starting to break to the upside here with yields. I think yields and oil are pretty well tightly correlated. When oil goes up, yields generally go up, and commodities go up with it. So that's what we're seeing. We're seeing yields go up. We've had that consolidation period right here, and we're going to start to see commodities outperform. And it's very important that you understand these correlations and relationships if you're an investor. It's been long and exhausting wait, but global oil inventories, both onshore and oil on water, are finally rolling over. Current global inventories are now at 6-month low, and we expect them to fall to a 5+ year low by year end. So we are rolling over in our oil inventories. Commercial inventories rolling over will lead to higher oil prices. I do know some people who work at oil companies. They are directors at some of these larger oil companies, and their expectations is that we could probably hit $100 this year towards the end of the year, and we'll see where it goes from there. This is the 10-year yield is now above the levels that triggered most of the issues across the banking industry earlier this year. It's intriguing to see investors drawing comparisons between today's environment and 2011, even though the differences couldn't be more pronounced. Back then, the Fed wasn't shrinking its balance sheet assets to the extent. Here, let me go back down here. Investors are clearly underestimating the potential issues that may arise from a structurally higher cost of capital environment, especially when over 90% of the Treasury yield curve has already been inverted. The fact that a recession hasn't happened yet doesn't mean that the probability of one is now lower. VIX is at a 15 handle. Credit spreads are historically suppressed, and equity markets remain absurdly overvalued. Something has to give. Financial conditions here, and we've got the 10-year yield just beelining up to the upside. We've got August 2nd. The census today says 2.1 million new households formed over the last year. Ignoring 2020 and 2021, this is the highest rate of household formations since early 2019. All signs point to strong demand for homes this year. Remarkable given the direction of rents and mortgage payments. So this is 2013. We only had 1.4 million households per year, 2013 to 2023 average. So 1.4 is the average households per year. Remember those housing starts. We went way below 1.4 million households for a very long time. We are drastically underbuilt. We can see household formations strengthening since COVID and moving forward. We've got 2.1 million household formations here from the last year of June. We've got Permian frac operations continue to fall as inventory concerns and productivity degradation issues are becoming more and more obvious. Last 10 weeks have seen all 6 of the lowest 6 readings over the last year, excluding Christmas of 2022, indicating a sustained slowdown is ahead in the Permian frac operations. So we could see a slowdown there. Almost every major housing market east of the Rockies, Austin being the main exception, just set a new all-time high for home prices in June, says Freddie Mac. And you can see all the all-time highs over here, and you can see some of the slowdown in the West. And that's where I'm going to end it, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We do have our discount August. We do have a 7 a.m. Mountain Standard Time question and answer session on Saturday. Love to see you there. Ask questions away. Obviously, we share as a group a bunch of different information, a bunch of potential investment opportunities. Obviously, you have to screen it to see if they work for you. But yeah, we talk about a lot of stuff. We've been very lucky on getting a lot of stuff right in the energy service sector. We're really doing well in that sector there. We're doing well in the exploration production sector. We've got some other stuff that I think it's cooking along the bottom. It's starting to turn and move on up. And let's hope that good luck will continue for us. We've been looking at patterns, finding some breakouts. We've got some that are kind of wedged up against resistance. And then when that resistance breaks, guys, that's when the fun begins. You just hold on and let that thing ride you. You have to ride that sucker higher. So that's what we've got for today, and we'll end it there. We'll see you next time. This is Finding Value.